today we'll be continuing with Unit 2, the past papers pertaining to Unit 2, and the paper we're going to be doing is 2019 Variant 22 Winter Question 1. So it's the full question, it's worth 20 marks. It's getting tested all from double entry system of bookkeeping, books of prime entry, and business documents. Okay, so let's go to the paper. This is the paper, and let's go to the questions and see. Okay, so first things first, let's start. Okay, so Sarah, I'm assuming that's Sarah. Sarah is a retailer of garden furniture. So this is important, garden furniture, because this is the business activity of Sarah's business. This is the business activity, which means she is a retailer, a trader of garden furniture, which means she either buys or manufactures her own garden equipment, or garden furniture, and sells it for final consumption. That's the job of a retailer. Okay, so the following ledger accounts appeared in her books on 31st August 2009. Wooten account. So let's figure out what type of account Wooten is. Okay, so obviously we'll have to check and see whether this is a trade receivable or a trade payable. That's the first objective in this paper. So in order for you to answer this question, that's the first thing you need to look at, because they're given you a ledger account. Your first objective should be to find out what type of ledger account this is. So those are the things, those are the questions that you need to be asking. Okay, so let's try and figure out what type of account. Wooton, I'm not sure if I'm pronouncing that correctly. Let's just figure out what type of account it is. Okay, so there are several ways for you to identify what type of account. Okay, and the important things that you look at, I think the first thing that you need to look at, the first thing is check to see if there is an opening balance. Now, why is this important? Well, it's quite simple, because with the opening balance, depending on which side it is, that is whether it is the opening balance is on the debit side or the credit side, we can figure out whether this account which element that this ledger account belongs to. So we know the only assets, equities, and liability ledger accounts have opening and closing balances. So one thing we can look at is, so all we have to figure out is which element this ledger account belongs to, whether this is an asset account, equity account, or liability account. So first thing is, if we go through the question, and I can see this on 1st of August, there is indeed the opening balance. That's how we figure it out. And we can see that it's on the debit side. It says $263 on the debit side. So what type of ledger accounts have opening balances on the debit side? Just one, asset accounts. Only asset accounts have a balance brought down, that is an opening balance on the debit side. Okay, so all we have to do is, now we know that this ledger account is an asset. The next step is figuring out what type of asset it is, and that we can do by looking at the transactions. Okay, so we know that the element that this ledger account belongs to is, it's an asset, or belongs to the element of assets. Next step is figuring out what type of asset it is, and that's quite simple. You can see the type of transactions I can see, we have a sales entry, a sales return. This looks like a credit balance. So this is the debit side, and this is the credit side. So what I can identify from this is, first thing is, okay, sales. Who does the business sell to? Sales. And we have sales returns as well. We can ignore these two as well, but I'll teach you how to figure it out with these two as well. But what you need to understand is, we have sales and sales returns. Who does a business sell to? That's the next question you ask. A business sells to customers. The next question you ask is, who are customers to a business and how are they categorized? Customers are also called trade receivables. Any customers who you sell to on credit basis automatically become trade receivables. So trade receivables are current assets and it meets the element of assets. So that's all you have to figure out. Who does the business sell to? Businesses sell to customers. So if we have sales entries and sales return entries, it's clear that the business has sold items to this person, therefore it's a customer. Customers who you sell to on credit, that is, how do you understand that? There's an opening balance. You sell on credit, that means they owe you money. That's why you have recorded an opening balance, an asset of 263. This customer owes you money. I hope that is clear. So we know that these are trade receivables. So we know that Vuitton is a trade receivable, a customer who owes us money. So we have figured out what type of account this is as well. It's a trade receivable. So the rest is simple. Now we can get to answering the questions. Okay, let's read the first question. Name the type of ledger account prepared by Sarah showing a balance after each transaction. Okay, this is a fairly new concept that they have brought in recently. Okay, but it's quite simple. What you need to understand is, this is the new format of creating ledger accounts. This is called a running balance ledger account. Okay, what is the difference between a running balance ledger account and a normal ledger account that we prepare? It's quite simple. In a normal ledger account, we usually enter entries for a longer period of time. We do not find the closing balance of a ledger account after every single entry. What we do is we record a lot of, this is primitive accounting, now not primitive, olden day accounting, this is before computerized accounting came into place. What we do is we record all transactions for an entire month and we total it after a month of transactions. So obviously that is a little inefficient because there's a high chance of making errors. So instead of that, or especially a concept that has been brought in specially or actually put into practice by computerized accounting, is running balance ledger accounts. And the difference between a running balance ledger account and a traditional ledger account is, a running balance ledger account, even though prepared manually, is prepared in such a way where we get the closing balance of the account after every transaction. Okay, so as you can see, the closing balance in the first of the month of August was $263 on the debit side. Next, since we know that this is a trade receivable customer, we can figure out what type of entry. We have a sales entry and the balance will be on the debit side. Why is that? Because the double entry for credit sale is debit trade receivables, in this case Vuitton, and credit sales account. So as you can see, this value of $70, the double entry is correct. So you will have a debit entry of 70 on Vuitton's account. So that is indicated here, debit entry. These are credit entries. So debit entries, obviously, if I were to show you it in a traditional ledger account, we have an opening balance of 263, and now an additional debit entry has been brought into this ledger account. So if we total this now, what is the total we get? That is $333. You see? So another rule or another way for you to remember this is, if you remember the double entry accounting, the rules of double entries. Debit entries increase the value of assets and expenses, and they decrease the value of income, equity and liabilities. So, and the opposite is true for credit entries. Credit entries decrease the value of assets and expenses, okay, and increase the value of income and liabilities. Okay, so we know that debit entries increase the value of assets and credit entries decrease the value of assets. Why I'm focusing on assets only is because this is an asset account. So we're analyzing an asset account. You guys should know already about what double entry does, so I'm not going to cover that. Okay, so debit entries increase the value of assets, which means your closing balance should increase. And if you look at the difference here between these two, it has increased from 263 to 273. The value has increased by $70. So we know that is to be true in assets. Debit entries increase the value and credit entries decrease the value. So as you can see, instead of balancing ledger accounts at the end of the month or end of an accounting period, which honestly can be quite a difficult task to do. Imagine if you have entries for a month, who knows how many entries you can have. So that will lead to more errors. So what you do is after every transaction, you update your closing balance. So debit entries increase, so it has increased from 233, whereas credit entries decrease the value of assets. So you can see there's a credit entry of $9, the balance has decreased from 333 to 324. Again, another credit entry of 144, so 324 minus 144 gives you 180. And then there's another credit entry of $6, which means the balance will decrease again to 174. So that is what a running balance ledger account is. And I know that was a long explanation, however I just want to take time and explain to you what type of ledger account this is. This is different to the normal ledger accounts that you all prepare. Okay, so that's question 1 part A. Question Roman numerical 1. Let's see. Roman numerical 2. Name the subdivision of sales ledger in which the account of Bhutan would appear. So when they talk about subdivision, what they're talking about is the 3 ledgers. Sales ledger, purchase ledger, and the general ledger. So we know now that Bhutan is actually a trade receivable and a customer, and all customers are recorded in the sales ledger. The sales ledger is a ledger which contains all the individual ledger accounts of each customer. Customer, in the sense customer. In real life, most of the time you're going to create a customer, because in reality businesses trade on credit more than cash. It's mainly credit transactions. There are cash transactions too, but most retailers trade on credit. With customers, yes, it's most likely to be cash transactions, but if you're specially selling to another entity, a business, it will be credit transactions. So it has all individual ledger accounts of each credit customer. Okay, that is a customer who you have sold goods to on credit. That is in the sales ledger. Whereas the purchase ledger has all your credit suppliers. All credit suppliers, that is people or businesses that you buy from on credit basis. These are liabilities. So the purchase ledger, not the general ledger. So what you need to understand is the sales ledger is your customer database. Is another way to, if in simple terms, it's just your customer database, the list of customers that you have sold goods to, and showing how much each customer owes you. That's it. If you picture it in an Excel, rows are customer names and the columns will have values of how much each customer owes you. So how much customers owe you. And yes, so the purchase ledger is basically your supply database. You buy from suppliers, therefore it will show you how much. It's a liability. Customers owe you money here. You sell, customers owe you money. Assets. The sales ledger is basically assets. One asset is basically trade receivables. As this is a liability, one liability, only one liability, not any other liability aside from trade payables. Only trade payables, no other liability. And the sales ledger is only trade receivables. no other asset. So all credit suppliers, it's a supplier database, meaning how much you owe. So with that information, it's fairly simple to answer this question. The subdivision of sales ledger in which the account of Bhutan would appear. Bhutan, a customer, trade receivable, belongs to the sales ledger. That's how we get the answer for that. Next, name the document sent by Sarah to Bhutan. Okay, that's easy. How you answer these questions, look at the date, 10th of August. Let's go to the 10th of August in your ledger account. On the 10th of August, you can see that it was a sales return. Easy. It's a sales return. What is the source document pertaining to a sales return? Any returns, whether it's a purchase return or a sales return, the source document is going to be a credit note. But when it's a sales return, you are issuing a credit note. It's your credit note. Therefore, you issue a credit note. So the source document is credit note issued. So if we look at it from Bhutan side, Bhutan bought items. If you sold goods to Bhutan, that means Bhutan bought items. So if you are the accountant of Bhutan, you receive. This will be a purchase return because Sarah issued a credit note and Bhutan received a credit note. So if you are the accountant for Bhutan, you're going to record it as a purchase return, which means a credit note received. As you can see, you received. Got it? So whenever it's a sales return, the source document is a credit note issued. Next. Name the type of discount taken by Bhutan on 15th August. So we have a discount here, 15th August, $6. On the credit side, two ways to do this. If you remember the double entry to record the discount allowed, it's debit discounts allowed and credit the trade receivable. But the easiest way to remember this is, what is the relationship between Bhutan and Sarah? Who is Bhutan to Sarah? As we already established, Bhutan is a customer and a trade receivable. Any discounts, so the two parties involved there are the business and the customer. So when the business and customer, when are the two parties involved, the discount is called the discount allowed. Discount received is a transaction between the business and the supplier. So that's all it is. There are two discounts, two types of cash discounts. Discounts allowed, discounts received. If it's business and customer, it's a discount allowed. If it's business and supplier, it's a discount received. Bhutan is a customer to Sarah, therefore this is a discount allowed. Next, calculate the percentage discount taken by Bhutan on 15th August. Okay, so if you know your double entry if you need to know your double entry accounting for this. Okay, so if you look at it, I've always told you this, every time there's a cash transaction, a cash discount, it is discounts allowed or discounts received, there will always be two entries on the same date in either the trade. In the case of a discount allowed, it will be on the credit side of the trade receivable account or the customer account, because a discount allowed means the business is telling the customer, listen, you don't have to pay me this amount, you have to pay me less. So how is the business going to record that? You as the accountant, when Sarah tells that to Bhutan, Sarah basically told Bhutan, I give you a discount of $6. How are you as the accountant going to record this? So Sarah is telling your trade receivable, the owner of the business is telling the trade receivable, Bhutan, pay me $6 less. Now in your ledger accounts you have to record that. And how you record it is by, you know that Bhutan is a customer, it's a discount allowed. Since you are not receiving the $6, you are going to bear it as an expense, which is why you debit discounts allowed $5 and credit trade receivable. Sorry, $6. In this case, trade receivable Bhutan. Okay, so as you can see, that is a credit entry on there is a credit entry on Bhutan's account of $6. So how do you identify the transactions? So to answer this question, you need to see what are the two transactions in the ledger accounts that are arising from the same, what are the two entries in the ledger account arising from the same transaction. As you can see, yes, same date, and we now know that the discount is $6. Okay, the next thing you're going to look at is, here you see, debit entry in the discount. Next is you're looking for the cash entry. So you understand this, when you're getting a discount, that means you are paying. So the two entries that you have to look for is the discount entry and the cash entry. The cash entries are the simple. Since the customer is paying you, your cash book asset is increasing, by 144 and credit trade receivable Wuton, because Wuton paid you money. If Wuton paid you money, then the trade receivable, the amount that Wuton owes you from this 263, from this 333, from this 324, how much is Wuton, that is how much Wuton owes you. So from that amount that he pays you $144, it means the amount decrease. Got it? So that has to be a trade receivable Wuton decreasing because it's an asset as well. These are both assets. Your cash balance increases because Wuton paid you, so that's a debit, and you decrease Wuton's account with a credit entry of 144. So this will increase assets, this will decrease assets. So as you can see, that means the bank entry has to also be on the credit side. So if you have cash entries and the discount entry on the credit side of the ledger account, that's another way to identify what type of ledger account it is. Okay, so if the cash entry this and the discount entry this are both on the credit side of a ledger account, you can assume, or not assume, sorry, you can conclude that this is a customer or trade receivable. That's another way to identify who Wuton is. Okay, so as you can see, this is, so we identified the two entries relating to the cash discount. You need that to identify the percentage discount. Okay, so what you can see is, so to find the percentage, what you have to do is add the cash entry plus the discount, which is 150. So originally this is the amount that Wuton had to pay you. Wuton had to pay you 150, but Sarah gave him a discount, him or her discount of $6. Understood? So if you're asked to calculate the percentage of the discount, you take the value of the discount and divide it by the original price, divided by 150 into 100. So that is 1.6 divided by 1.5, which is basically 4%. So the value percentage discount is simply value of discount divided by cash entry plus discount into 100, which is basically 4%. Here. Next, let's get to part 4. Name the document which should be sent by Sarah to Wuton on 31st August detailing the transactions for the month. Detailing the transactions for the month. Okay, so this is an interesting source document. What this is, so now we know that Wuton is a trade receivable, a customer who owes you money. So the name of the document is called a statement of accounts. Basically, a statement of accounts, a statement of accounts is a report which shows a detail of all transactions made between the customer and business. Okay, a statement of accounts is a report which shows a detail of all. So what it does is it shows the customer how much he or she owes, which is basically the closing balance. Understood? So in the beginning of the month, Wuton owed us $263, and after certain transactions in the month and after certain payments that he or she made, there's a closing balance of 170. So it shows the closing balance, how much he or she owes. It shows the customer how much he or she owes and how they arrive at that balance. So that means the transactions that occurred within this month in order to arrive at this closing balance. So it will be something similar to this, but instead of saying sales return sales, it will have more document numbers. It will say invoice number, because this will say source document of a sales return is a credit note, so it will have credit note number here and the value. Bank remittance advice, a payment source document for bank payment is remittance advice or check. Okay, remittance advice or check, depending on how they paid. If they made an online payment, it will be bank, it will be remittance advice. If they deposit check, it will be check. It will have either remittance number or remittance advice number or check number. For a discount, there won't be any source document, but yeah, it will show how discounts won't appear in the statement of accounts. That will be netted off, but yeah, it will basically show you how each transaction affected your balance, your opening balance, and resulted in your closing balance. So this is a document, that a report that you will send to your customer, because you want to show the customer, hey, listen, you bought these items from us, you owe us this money, you returned these items, those amounts were deducted from your total bill. You can consider it like a total bill, a detailed breakdown of a total bill, like a phone bill, which shows a detailed list of all the calls that you made, something like that, and shows you how they arrived at the closing balance. So you send it to the customer so that the customer knows how much they had to pay, which invoices are outstanding, and how much they have to pay, and which invoices also are outstanding. Clear? So that is the document that you will send to vote on, because you're sending it to the customer, asking the customer to pay you your balance, showing them how much they owe you, not to pay you the balance, showing them how much they owe you. So statement of accounts. Next, let's go to part B. Complete the following table. For each transaction, name the book of prime entry, original entry, the account to be debited, the account to be credited, and the effect on capital. The first item has been completed as an example. Okay, so sold goods on credit to Win, 300, cost was 210. That means what? You sold goods for 300, it costed you 210. So remember, effects on capital. Okay, let me go through this format first and explain the format. Okay, in the first column you have to write the book of prime entry. How are you going to answer those questions? You go to the transaction, identify what type of transaction it is. Based on that, you can categorize it into a book of prime entry. The individual ledger accounts to record that entry, and the effect on capital. So this is the account to be debited, the account to be credited, based on double entry rules. So if you figure out what type of transaction, that's all you need to know, because once you figure out what type of transaction, you can figure out the book of prime entry and the individual ledger accounts that need to be recorded. Let's touch on effect on capital, because I feel like a lot of you forget this. What are the instances that can change capital? We have covered this as well, but I'm just revising. Instances that can change capital. There are only 4 instances: income, expenses, capital, and drawings. Okay. So if income increases, equity increases. If income decreases, equity decreases. If expenses increase, equity decreases. And if expenses decrease, equity increases. So because the formula is simple, sorry, it's easier to explain it with the formula. To the equity balance or capital, I know they're using the term capital here, but the term they're referring to is actually equity. So the formula to calculate equity is plus capital plus income minus drawings minus expenses. So as you can see, drawings and expenses are deducted, whereas capital and income are added to equity. So if capital and income increases, equity increases, and if capital and income decreases, equity decreases, whereas the opposite is true for drawings and expenses. As drawings and expenses, since you're deducting it from equity, as drawings and expenses, the value of these two variables increases, equity decreases. But if the value of these two variables decrease, look at that. So if it decreases, what it means is the amount that you're decreasing from equity has reduced. Got it? So if drawings and equity decreases, equity will increase. But if these values increase, then equity will decrease. Got it? So if these values increase, that means the amount you're deducting from equity increases. So therefore the value of equity decreases. Understood? And the opposite is true for capital and income, because you add capital and income to equity. So the amount that you add, that is if these variables increase, so the amount that you're adding to equity increases. But if these variables decrease in value, that means the amount that you're adding to equity decreases as well, which is why when capital and income increases, equity increases, but when those capital and income decreases, equity decreases. And why when drawings and expenses increase, equity decreases, whereas when drawings and expenses decrease, equity decreases. Okay, so the reason we need to know that is, now that we're clear about that, we have to look at the only entries that can affect capital are, you're going to look for income entries, expense entries, capital entries, and drawing entries, okay, from each transaction. If none of these elements are affected in any of these transactions, there will be no effect on capital. So as you can see, if you look at the first transaction, let's go through it now. Okay, we have sold goods on credit to Win, $30, $300, and costing $600. So you sold, which is an income. Oh, so definitely there's going to be an effect on capital. So you sold goods for $300 and it costed you, which means your expense of obtaining these goods was $210. So profit or loss is basically equal to income minus expenses, which is basically $90. And since income is higher than expenses, profit is therefore an income. So the $90, this is a profit. So income is higher than expenses, therefore you made a profit. And since in order to get a profit, your income has to be higher than your expenses, $90 is an income, and incomes have increased, so profits increase income, okay, which means, so it simply means you made more than you spent, you made a profit, okay. Making a profit increases the value of your equity. So as you can see, that's why equity has increased by $90. So sold goods, double entry, sold goods costing $300. So this is a credit sale, okay. The book of prime entry is a sales journal. All credit sales go to the sales journal. Account to be debited. Double entry for credit sale is debit trade receivable. In this case, the customer is Win. So goods to Win. Credit sales account. All sales go to the sales account. This is an income. This is an asset. So that's correct. You can see. Win account to be debited, sales account to be credited, effect on capital. Okay, next we'll say paid wages in cash. Remember, all cash transactions are recorded in the cash book. All cash transactions recorded in the cash book. What's the double entry for this then? So the book of prime entry is the cash book. So this is paid wages in cash. Wages is an expense, so you debit wages account. Because you pay expenses, that means your expenses have increased, and you credit your cash book. Why? Because it's an asset, and when you pay, the value decreases. Understood? You paid cash, so your cash balance decrease, and asset decrease, credit. So the double entry should be debit the wages account, which is the expense account, and credit cash book. Wages is an expense, your expenses increase by 750, which means equity will decrease by 750. Remember I told you when expenses increase, equity decreases. Next, purchase a new computer system on credit from CW Limited. This is interesting. She's a retailer of garden furniture, so a computer system. So Sarah is a retailer of garden furniture. Not a computer is not garden furniture, which means she has bought a computer system, which means it's a purchase of an asset on credit. So this transaction is a purchase of non-current assets on credit basis. Okay, so it's not a cash transaction because it's on credit basis. See, on credit for CW Limited. You bought it on credit. It's not a trading good. So now don't get confused. Don't think this is a trade payable. It's not a trade payable. Trade payables are only the suppliers who you buy trading goods from. If you are buying non-current assets from another person, yes, they are a supplier. However, they are not trade payables. They'll be categorized as other payables. Okay, there's this entire different category called other payables. They fall under that category. Trade payables is from the purchase ledger only. The purchase ledger accounts, which is all the suppliers that you have bought trading goods from. Okay, so here you bought a non-current asset because she's a garden furniture salesperson, a garden furniture retailer. Computer systems are not garden furniture. She hasn't bought a trading good here. Understood? So other payables, but yes, it's a purchase of a non-current asset on credit basis. So it is not a credit purchase. Okay, this is not a credit purchase because they haven't bought trading goods. It's not a credit purchase. It is not a cash transaction. You have not paid money for it, which means this is a purchase of a non-current asset on credit basis. Purchases of non-current assets go to the general journal. Okay, we have 7 journals, books of prime entries, sales journal, which records credit sales, only credit sales of trading goods, purchase journal, which records only credit purchases of trading goods, the sales return journal, which records all your credit sales that have got returned, and purchase journal records all your credit purchases of trading goods that got returned. After that, you have your cash book, which records all cash transactions, and then you have your petty cash book, which is there to record small petty cash expenses, and then finally you have the general journal, which records all other entries. So you have entries such as non-cash expenses, non-cash entries, especially creation of provisions, creation of mainly provisions, income tax entries, basically mainly provisions. These are called non-cash entries. Understood? Recording other receivables and other payables. All those go to general journals. Purchases of non-current assets on credit basis. General journal. So the double entry here is you purchase a non-current asset. So non-current asset in this case will be computer system. You want to show what your non-current asset is. So it's a computer system that you bought. You bought it on credit. Same rules apply. Other payables, supplier that you owe money. So liabilities increase. That's CW limited. Is there an effect on capital? No. I'll show you why. If you remember your accounting equation, assets equals equity plus liabilities. So when you debit computer system, which is an asset account, it's going to go up by 1,500. Equity will remain the same, and liabilities will go up by 1,500. We have asset and liability accounts, as you can see. So let's say in the first scenario, let's say equity was 100. You can see, so equity will be equal to assets minus liabilities. Take liabilities to this side. So 100 will be equal to, no, sorry. Equity plus liability. So let's make equity E the object of the formula. So you take liabilities. So it's 1,500 minus 1,500. Equity will be 0, which means equity did not increase. So when assets and liabilities both increase or assets and liabilities both decrease, there is no change on equity. It's a formula, balances out. So there is no effect, or you can write no effect. Finally, received goods return which had been sold on credit to vendee. Received goods return which had been sold on credit to vendee. You have sold goods on credit. So customer, vendee, it's a sales return. So the book of prime entry is a sales return journal. The double entry to record a sales return. In a sales return, income decreases. That's a debit, and you record it in a ledger account called sales returns. The next element affected is customer, which is assets, trade receivable, vendee, credit. Understood? Assets also decreases. Customer return items, they're not going to pay you for it. So the double entry is you debit the sales return account and you credit vendee. Again, here is there an effect? Yes, income decrease with the debit entry. So again here you sold it for 150 but the cost was 180, so here you both your income decreases by 150 and your expenses also decrease by 80. So the net effect between the two is $70. Your profit, that means, decreases by 70. So yes, minus 70. So remember, income decreases. What happens to equity? Equity equals plus, so equity is capital plus income minus drawings minus expenses. So when the value of income increases, equity plus 150, and when the value of when value of income decreases, equity will decrease when income decreases, because you added, the amount that you add has decreased, so minus 150, and expenses has decreased. Expenses decrease mean, what is the effect? If the amount you're deducting from equity decreases, that means equity increases. So the amount you decreases, you add expenses that decrease. Income that decreases, you minus from equity. Expenses that increase, you have to add. Expenses that decrease, you have to add. So the net effect is minus 70. Equity has decreased by 70. Clear? And the final question, small theory question. State 2 advantages of ICT accounting. So what are the advantages of having a computerized system? One thing is, it is more efficient. As a single entry, gives single entry. So it is more efficient as a single entry completes all the double entries. What that means is, you don't need to do double entry. You might need to do double entry account in certain instances. Yes, you do. But with one entry, everything gets updated. Okay? You don't need to worry about like drawing 2-3 entries. Writing up 2-3 entries. The next thing is, you can extract financial statements at any time. Whether it's correct or not is up to the accountant, but if the accountant has recorded every transaction correctly, at any time you can extract a financial statement, an income statement of profit or loss, or a statement of financial position. Also, because it maintains, like what you learned here, in a computerized system, every ledger account is a running balance account. It's always showing the most up-to-date ledger balance. So anytime you can extract a financial statement. So those are the benefits of ICT accounting. So thank you very much. I hope you guys, I hope you guys go through this lesson and learn something, and please practice this paper. It's for your quiz. This is just 20 marks, very easy. 43 minutes. Okay.